The Chinese tech giant Wall Street loved, then hated, and now seems to have entirely forgotten about. Tencent is one of the most dominant cash printing machines on the planet, but its stock price tells a story of fear and geopolitical panic. So, is Tencent a massive value trap, or is this a great buying opportunity? Welcome back to MoneyJourney. In today's video, we are doing a complete deep dive into Tencent. We are going to tear apart their fundamentals, map out their sprawling business model, and highlight the incredible competitive advantage that make them a monopoly. But we don't sugarcoat it. We are also driving headfirst into the bear cases. Finally, we'll run Tencent through our strict MoneyJourney quality scorecard and execute a rigorous valuation analysis to calculate its true intrinsic value. If you want elite nonsense stock analysis to help you beat the market, hit that subscribe button right now and to join the MoneyJourney community. Let's dive in. To understand Tencent, you have to realize they aren't just a tech company. They are the digital infrastructure of daily life in China. At the core of their business model is WeChat, a super app with over 1 billion active users. It's where people text, shop, order food and pay their bills. They heavily monetize this ecosystem through digital advertising, fintech and cloud service. But Tencent is also the undisputed kingpin of global gaming, completing owning or holding massive stakes in giants like Riot Games, Epic Games and Supercell. This brings us to their competitive advantage or economic moat, an impenetrable network effect combined with sky-high switching costs. You simply cannot function in modern Chinese society without WeChat. On top of that, Tencent acts like the Berkshire Hathaway of tech, utilizing an elite capital allocation strategy to invest their massive free cash flow into emerging global innovators. However, we have to look at the dark side. Let's talk about the bear cases. The biggest elephant in the room is regulatory and political risk. The Chinese Communist Party has a history of sudden crackdowns on tech monopolies and gaming hours, which has severely suppressed Tencent's growth in recent years. Secondly, geopolitical tensions between the US and China keep a massive amount of Western institutional capital completely locked out of the stock due to delisting fears. Finally, a sluggish macroeconomic environment in China puts heavy pressure on their ad and cloud revenues. The risks are incredibly real, but as we are about to see, the moat might just be strong enough to withstand it. Let's open Tencent stock in our MoneyJourney stock analyzer. What I love in Tencent vision is that it results in incredible competitive advantage and incredible fundamentals. When you look into revenue, net income and free cash flow, we see incredible, very steady revenue growth, net income and free cash flow growth, which results in net income and free cash flow per share growing as well. So even though Chinese economy is facing plenty of headwinds, Tencent remains very strong, growing each and every year. This is the result of an incredible business model. Revenue growth steadily growing around 10%, net income and free cash flow per share very steady, growing each and every year. Margins actually expanding from gross margin 42% to 56% last year. Right now we are seeing free cash flows and net income margin around 30%, which are really high, and we really love that in Tencent business. Shares outstanding going down. Tencent management, besides buying stakes and really great companies and have a really great track record, they are buying back their shares too. The share dilution is very high, so it's something that we like to, especially when Tencent was trading really cheap in the previous years. So when you look into our quality scorecard, analyzing their business model, one of the best companies out there. Imagine if you compare to the US peers, it's like a Meta Google, with the PayPal business, all inside their ecosystem, and besides that, one of the leaders in gaming. So it's a really incredible business model, which is one of the best companies in the planet and very important for China. So revenue growth, market potential, I really love the recurring quality of the revenues, which when you compare the previous years, which China was in an economic slowdown and the company was growing around 10%. This only happens in really great business. And even when you compare to other great companies like Alibaba, which grew in the same period, their profitability was facing margin compression and the profits were down. Their margins were down, I would say. Tencent profits not. It was an incredible cash printing machine, even when the Chinese economy was facing a lot of difficulties. Really great margin, plenty of pricing power. The only thing that could be a bear case for the pricing power could be a government making or adding new rules to their business or making difficulties for them to sell their products. Besides that, there are plenty of pricing power to the consumer. High rates of return around 15%. Management, in my opinion, one of the best ones. You just have to see the track record of Tencent in buying stakes in other companies, buying companies, increasing their assets over time in the last decades, and you'll be very satisfied as a shareholder. For me, it's an impenetrable monopoly. You don't face competition in China. It's infrastructure of the Chinese economy. You will not live very well, or will have plenty of difficulties to be in China on your day-to-day life and not using WeChat. So it is a monopoly, impenetrable, so no competition in there. Even though they are a very big company working in different sectors, if you look into their position overall, WeChat advertising, they are the leaders, but if you watch cloud, they are number 2. If you see gaming, they are probably the biggest company in terms of gaming in the world. In terms of payments, top 1, 2 in China. So everything they are invested in, they are the leaders or the top 2 or 3 in China. So this shows what Tencent quality is. So free cash flow per share growing around 20% per year, which is incredible, and they are doing plenty of buybacks when the company is cheap and they have excess cash. So in my opinion, my favorite company on China. But is it cheap as other companies are? So it is a Chinese company, plenty of risks. When you do a valuation, for me, you have to pay for me to invest in a Chinese company, I have to receive a premium. So since it's, for me, in terms of risks, median safe company in China. But for me, the minimum discount rate will be 15%. And for me to buy Tencent at 50%, it has to be a really great value. So, but what should be my assumption? I expect them to grow around 10% per year, free cash flow margin around 30%. I'm being conservative, so margins are around 30% in the previous years, but there are years where the free cash flow are around 35%. They've been growing around 10% in bad times. I believe with China resuming consumer confidence increasing, starting to recover, we could see Tencent growing around 12 to 15%. So I'm being conservative here. In terms of PE, I'm only assuming 20 because it's a Chinese company. If you assume a 25 due to their track record, return on invested, their moat, they easily could deserve a 25 P. But base case discount rate 15%, and with that assumption I come with an intrinsic value around $62.8. TCEHY is trading around $50 right now. For me, full disclosure, I own Tencent. I bought 3 years ago and I never had the opportunity to add to my position, but right now I'm starting to get interest again in Chinese stocks. Baba is cheap again. Tencent, I would like to increase my position around 15%, so I'll be looking into this. To wrap this up, Tencent remains an absolute powerhouse of a company. Yes, the news cycle is full of negativity, but underneath that noise is an incredible business with elite fundamentals, massive free cash flow, and a moat that most companies could only dream of. There is undeniably a lot of macroeconomic and geopolitical uncertainty, but as our valuation clearly shows, investors are currently expecting very little from Tencent. That pessimism is exactly what creates a margin of safety for value investors. But I want to hear from you. Do you think the regulatory risks make Tencent uninvestable? Or is this current valuation just too cheap to ignore? Let me know your thesis down in the comments. If you got value out of this deep dive, please smash the like button and subscribe to MoneyJourney so you never miss our next intrinsic value breakdown. See you in the next video.